Money, control, and public choice in an era of illicit finance. 1. Executive Summary. You evaluate a claim that the United States leads global money laundering while facing a policy dilemma framed by a red button that could halt hard narcotics trafficking instantly. You confront the tension between moral clarity and material dependence, recognizing that public and private actors may resist immediate eradication when their budgets, asset values, or livelihoods rely on illicit flows. You must separate rhetoric about virtue from revealed preferences that surface when costs and trade-offs are explicit. Footnote. This section directs you to state the thesis and identify the central conflict between ethical imperatives and embedded economic incentives. 2. Framing and method. You proceed by treating the red button as a controlled thought experiment that tests whether communities will internalize the downstream fiscal and distributional effects of cutting illicit cash flows. You read the scenario as evidence of preference falsification where actors publicly endorse integrity yet privately decline costly integrity. You adopt a public choice lens that asks who pays, who gains, and who decides when enforcement abruptly changes. Footnote. This section explains that you use a thought experiment and public choice analysis to interrogate stated versus revealed preferences. 3. The red button hypothetical. You imagine a lecture hall where only one person will press the button that ends hard narcotics trafficking. You infer that 99 refuse because they anticipate reduced funding, lost patronage, or shocks to asset prices that were buoyed by illicit liquidity. You therefore treat non-action as an admission that parts of the licit economy are indirectly capitalized by illicit markets, and that abrupt prohibition without transition planning can trigger fiscal stress. Footnote. This section uses the button scenario to highlight how dependence on illicit liquidity can suppress collective willingness to act. 4. The control grid claim. You assess the assertion that a digital control grid is designed to manage populations toward a lower economic footprint. You analyze how fine-grained surveillance, programmable access to payments, and automated compliance can ration mobility and consumption when policymakers prioritize stability over autonomy. You note that such architectures can lower enforcement costs while raising risks to civil liberties if safeguards, due process, and sunset rules are absent. Footnote. This section argues that population-level controls can be efficient for enforcement yet hazardous for constitutional freedom unless tightly cabined. 5. Distribution and decline. You evaluate the statement that the majority will become poorer during transition from illicitly lubricated growth to tightly controlled finance. You connect this to contractionary effects when shadow liquidity is removed and when compliance costs rise for households and small firms. You consider how regressivity emerges if surveillance tools target end users while upstream beneficiaries of past flows remain insulated by secrecy or political bargaining. Footnote. This section explains why adjustment burdens may fall on median households unless distributional safeguards are designed ex ante. 6. Where the money goes. You pose the core inquiry: where does the diverted or laundered money reside when controls expand? You map likely destinations that include opaque entities, high-value assets, compliant intermediaries, and safe harbors that arbitrage jurisdictional gaps. You conclude that without transparent ownership records, auditable cash flow trails, and credible penalties, you will not redirect value to public benefit, and poverty will deepen despite stronger controls. Footnote. This section states that tracing ultimate beneficial ownership and transaction paths is necessary to convert control into equitable recovery.